All right, let's go ahead. Implied returns and cash flow volatility. We'll again try to understand what is the implied return of fixed income, what is the implied return of growth of equity, right? What is the cash flow additivity principle, forward interest rate, very interesting. Forward currency exchange rate, very difficult. Option pricing model, very interesting. Option pricing model examples, right? Quite a lot of numericals. If you are able to complete it today, that's good. If not, we'll continue this tomorrow also, right? Objective is that you guys should understand. Okay, so let's start ahead and try to understand. Okay, firstly, we are trying to understand the implied, right? Implied return, right? Implied is something which is not stated explicitly, but which comes out from itself, right? So, implied return for a fixed income security is known as the yield to maturity, right? Which a concept which I explained you very well yesterday. The whole logic here was that YTM is that rate which we kind of equates your cash flow, present value of cash flow to the current market price. This is a single. Yesterday also we talked about single. I told you, right? We had a lot of different spot rates. We decided no, we don't want different spot rate. We want a single annualized rate of return that investor would earn if they bought the bond today and held it until maturity. This is very important line which I did not touch upon yesterday. Please understand when we calculate your you know YTM. YTM when we calculate the calculation of YTM will only be true when we have this assumption that the bond is held until maturity. Very vital, right? So, because if a bond is being sold in between, right, then how can you discount all kind of cash flows, right? So that is very important, right? What I'm trying to put across is the calculation of ITM or the assumption of ITM will not make sense if you violate this assumption. And this comes in exam also sometimes, right? Uh, this is a very vital assumption. If this assumption, if a statement tells you that this assumption does not hold true, then YTM does not hold true, right? So you have to remember this assumption held until maturity, assuming all payments are made and the investor is able to reinvest the cash flow at the same rate. Another assumption. So another assumption is you are. I'm writing it here, guys. Very important. This is tested in exam, right? Very important that investor is able to reinvest at same rate. Okay. All right. So that's the basic point we need to understand, right? Very important, guys. There is a reason I'm writing this here because please believe me, they will give you a statement and they will say bond is not held into maturity, investor is not able to reinvest cash flow at the same rate. If these assumptions are violated, the YTM cannot be found, right? Please understand. And next is same thing which I taught you yesterday itself, that very clearly that YTM equates the current price to the present value of the face value, right? Which I told you, right? It is the current price to the discount, you know, current price to the present value of the cash flow, right? Equates the bond price to the present value of the all future coupons and the final face value. So this is what I taught you yesterday also, right? YTM is nothing but it is equating the current price to the present value of the all cash flow, right? And this requires an iterative process or financial calculator. Please remember this very clearly. YTM cannot be found by equations. YTM can only be found out by financial calculator because it's an iterative process. Iterative process means that you are saying that okay, present value, let's say, of a bond is your, let's say, bond present value is 101, and your cash flows are coming at 8 divided by 1.0, say 1 point your YTM right? 1 plus YTM, right, raised to power 1, right? Again, a cash flow is coming 8, 1 plus YTM. So the whole point which is made here, like a lot of students, what the mistake they do is they think that, sir, I can solve this equation by normal mathematical method which we have learned in school, colleges, etc. No, you can't solve it because, right, this is a very complex equation that can only be solved by either financial calculator or it's an iterative process. Means you put a value. Let's say you put a value 6%, and then you say that, oh, the my answer came out 100.55, so we will increase it. Okay, let me put 6.5, let me see where it goes. So if let's say you put 6, you get 100 point something, 6.5 you got 102, then you will realize that, okay, it means 101 lies between 6 and 6.5, right? So just remember it, that it's just a point, small point, that's why you use financial calculator for this. Whenever, like my point here is, whenever you get a question of YTM, right, don't try to start solving equation. YTM can only be found in your exam by financial calculator. So keep this in mind, because see, I have taught for many years. I've seen students, sometimes they think that, sir, why can't I find YTM like this making equation? You can't find it because it's a very complex equation where your mathematical things will not work. You need advanced calculators, which is why you have financial calculator, right? So YTM can only be found by financial calculator. So if you get a question in exam or in practice of YTM, don't try to solve by equation. Use a financial calculator. Okay, fine. Next one is implied return and growth of equity. Okay, again, so what was the previous one? If you think, what did we do in previous one? We were looking at implied return of fixed income, right? So we decided that, okay, implied return of fixed income, it is YTM, and the whole logic is implied return of fixed income. If somebody asks you, treat that as YTM. Very straightforward. If they don't give you, they give you YTM. That is the implied return of fixed income. Now, question comes is implied return and growth of equity, right? Or especially the implied return of equity, right? Here we have another model, right? We have Gordon growth model, right? Gordon growth model gives you the implied growth of equity, the relationship between a stock price, its expected dividend, expected, not the previous dividend. Expected dividend means next dividend. Its required return and its long-term growth rate is captured by a model called GGM, Gordon growth model. I told you, right? You studied your dividend discount model. Now you're studying another model, Gordon growth model. What does Gordon growth model says? Gordon growth model gives you a relationship. What relationship the Gordon growth model is giving? It's giving you a relationship that V naught is equal to your D1, right? KE minus GC, right? So this is same thing, right? This is the same thing, the dividend discount model which you saw, right? DDM. Another fancy name of DDM is GGM. This is what you saw earlier, right? This was the relationship. That there is another name. Earlier we did not study the name. Now we are putting the name to it. That the name of this thing is Gone growth model, and from this model you can calculate your KE, right? KE, okay, KE, and that is very easy, right? KE plus GC you can take on one side, right? So KE becomes D1 by V naught plus GC. You don't even to remember this formula. I never remember these kind of formula, guys, because this is you these are just you know what you say, left doing, putting things left, right. You don't need to remember this formula, don't need to remember this formula, don't waste your time remembering these formulas, right? Only remember this formula, right? You all are smart, you can take K whichever side you want to take, GC whichever side you want. Like, don't spend your time in remembering too many formulas, right? This is the basic formula. Just remember this, you are totally fine, right? This is unnecessary. See, these are put here because your syllabus has put there, right? But whole point is that if somebody tells you to calculate implied required return is KE. Somebody tell you to calculate growth rate, that is GC. That you can do on your own also. Right? Next one, forward price to earning ratio, right? Forward price to earning ratio. Now you haven't studied what is forward price, right? So Forward price is basically, it's always like what is the firm's share price estimate next period, right? So that is your forward price. So here they have given that forward price to earning ratio. So forward price is your VT, right? Forward price to earning ratio divided by ET plus 1. Now you will get surprised, sir. Why this is ET plus 1, right? Please keep in mind very, very clearly, you are basically looking at forward earnings, right? Right. And then you have what? Dividend of T plus 1, next period dividend divided by your earnings of T plus 1, right? Basically nothing but this formula, right? What are we doing? The above formula only. Let me write it if you are getting confused. See, it looks like a tough formula, but it's a very easy formula. Why it is easy formula? Let me write down. See, you learned this formula yesterday also. You learned this formula today also. You solved the equation also. So you learned this formula Ke minus Gc. That's a perfect formula. Now what I'm saying, right? You're just saying V naught divided by exponent, not exponential, forward earnings. So if you're dividing by forward earnings, what will happen? Right? It is basically the next period earnings, right? You're converting V naught and D1. So T, if I'm getting T plus 1, this becomes T, right? One period behind, right? So this D1 becomes T, one period behind. Expon, this earnings T plus 1, right? And because it divided here and Ke minus Gc, right? So it looks like a difficult formula, but it's not, right? It's a very simple formula. Just remember, sometimes you use it, we'll use it in the questions ahead, okay? So very straightforward. Then let's do the question now. Again, since we are doing the question, I'll take it on your uh, OneNote. So there you can write properly. Just so if I take it here now, you can see the question. In this question, what are we doing? Right? We are saying that consider a Swiss Confederation zero coupon bond. Right? So it's a bond question, right? And in this particular question, if we uh, pay attention, right? So what is happening is this is ZCV with the par value of CHF 100, right? Par value is the value which you get at the last, right? Par value. A remaining time to maturity, remaining, right? Remaining. It's not the full time to maturity, remaining time to maturity of 12 years and a price of CHF 89, right? Your Swiss franc, right? CHF Swiss franc, right? Right. So value at the last you will get 100. 12 years are pending. Today the value is 89. Okay. In 3 years' time, the bond is expected to have a price of CHF 95.25. Right? Again, interesting. In 3 years' time, means from here till here, third year, right? If I count it 0 to third year, the price expected here is your 95.25. If purchased today, the bond's expected annualized return is closest to. Now, this is very tricky, right? Because it seems like that you haven't done any like such question before, right? And how do you solve it, right? Because you are given a value of the bond 3 years from now, that is good. Now, the only question comes is that is there any way I can figure out this thing, right? So, if you apply a first principles approach, right, very simple first principle approach, The logic here is, in the first principle approach, is that you take your future value kind of thing. FV is equal to PV, right? Now question comes is, should I take exponential RT, right? Should I take your 1 plus RT? What should I take, right? How do I take it, right? If I am uh, putting it, right? If I'm putting it, how do I uh, understand it, right? Whether a zero coupon bond also plays a particular kind of value here, because there is no in between any coupon, right? I understand that there are 3 years here, right? So how do I now solve it, right? What should be the logic that I get the right answer? Any idea? Anyone? There's a small trick. See, this is given. Present value is 89. Future value is 95.25 after 3 years. Time period I am also aware 3 years. Right. Now the only thing is I have to create an equation. Right. Now what equation it will become? That is my concern. Right. That what equation it will become, and how do I solve it? Right. What should be the logic I should put it? Any idea? See, same logic. FV, if you have to find out the PV, present value, is equal to FV 1 plus R raised to power n. Right? This is what we have, right? Whatever, because see, ultimately you are discounting, right? This is 95.25. This is 89. You are asking this much, right? You are asking what is the return with this period, right? This 3 years. So you're discounting, right? 95 divided by 1 plus R raised to power n, right? So 95.25, 1
We'll
plus
divide 89 and put power of 3. 1 by 3.
89 is equal to 1 plus R raised to power n, right?
Yes, sir. And
Right?
we'll divide 89 and
Yeah,
n
yeah.
is 3, sir.
Yeah.
So,
So n is 3, right? Yeah. So what I'm saying, 89 is equal to 95.25, 1 plus R raised to power 3. Am I right? So 1 plus R raised to
yes,
power
sir.
3 is equal to 95.25 divided by 89. Right? If you try to solve it, 1 plus R will be 95.25 divided by 89. You take the cube root, right? So where is my calculator? So if we take the cube root of 95.25 divided by 89, and I take your mm,
2.88,
raised to,
approximately 2.9.
raised to power 3. Raised to power is should be, no, not 3.33 now. What you say? 0.33. 2.26, right? 2.264 it is coming for me. Maybe I'm try it again. 95.25 divided by 89, and then raised to power 0.33. I'm taking 2.2649 it is coming for me. But yeah, I think maybe some rounding off thing. But this whole thing is coming as 2.26 uh, 4 2.264. Sorry, this whole thing is coming for me after this 1.022649. For me, it is coming like this. So R is equal to 1.022649 minus 1, which becomes 0.02264, right? 2264, and it becomes like multiply, so 2.26264, which is, maybe there is a rounding off for me, but it is 2.29%. Okay, because there is nothing close to that. Okay, so again, it's a very simple kind of question. I don't think there should be any problem, but yeah, go through it, understand it deeply, right? Very, very important. Okay, again, it's a first
The
principle.
12-year part is not relevant. Is
It,
that
no,
not relevant?
that is just try to confuse you, right? So
So is this YTM 2 to 2.29 is the YTM?
it's uh, it's not a YTM, right? Because see, what we are trying to see is only the return for 3 years. YTM is when we will hold the bond for 12 years until maturity, right? I told you, na, YTM is only applicable when we are not like we are calculating here 3 years, right? So it is not. Yeah, I have to take 100. If I take it from 100 to 89, that will be my YTM. Okay. If I take it, same thing, your present value is equal to your FV, and in between I take nothing, right? I take only 89, 100, and 12 years, right? This calculation will be right here, right? So if I take it, 89 is equal to 100, 1 plus R, right? Or T is 12, right? This R will be your YTM, right? Got it?
Yes,
YTM
got
will
it.
only come when we have held until maturity. Otherwise, will not come. Okay, fine. So now this is done. Another question.
Sir, just a doubt over here.
Yeah,
So in usual circumstances, we don't get the right answer. So do we have to take the nearest round off?
yeah, yeah. See, I don't know why didn't we get the answer here right, but this much deviation is it's okay, right? 2.26 and 2.29. That much is okay, right? CFA will never, they will never like the quality of question is CFA is very clear. They don't try to give unnecessarily confusing options, right? They give it very clearly. Okay, nearest will work.
Sure, sir. Because even I tried solving some question and there were some, I mean, rounding off
Yeah,
errors
yeah.
from my side as well.
Rounding off will always be there, right?
Sure.
Okay. All right. So Grupo Ignacia, again another question. Grupo Ignacia issued 10-year corporate bond 4 years ago. Okay. The bonds pay an annualized coupon of 10.7% on a semi-annual basis. Again, right? Very similar to yesterday we did, right? Semi-annual basis, right? And the current price of the bond is 97.50 per 100, right? The YTM of the bond, right? Very interesting question because now we have been told to calculate the YTM, right? So again, YTM, I told you, right? Whenever you see a YTM question, the first thing it should come to your mind is that it has to be solved by calculator. I can't solve it by my equations, right? That is why I told you very clearly. As soon as you see the question asking YTM, the first thought in your mind should be calculator, no equations calculator, right? So it makes your life little easy, right? So you say that okay, fine, let's not waste time in creating equations, straight away calculator, right? So this is a hack I'm giving you. A lot of students don't remember this hack and unnecessary gets confused, right? You have to solve question in time, right? So your mind should be very clear, absolutely clear, that where should I go? YTM I have to find calculator. So calculator, then I have to, I need to, there are five things I need to know. I need to know PV, I need to know FV, I need to know PMT, I need to know I by Y, I need to know N. Out of five, I need to know four things, fifth I can find. So YTM I have to calculate, so this I have to find I by Y. Let's look for others. The 10-year corporate bond 4 years ago. How many years pending? 6 years pending. Semi-annual basis multiplied by 2. So N will be 12. Right. So I'm just giving you proper hacks, guys, how you can do faster questions, right? See, you will understand things, but if n is being multiplied by 2, right, what is the thing which will be kind of divided by 2, right, which will be your coupon, right? Coupon will be divided, right? So 10.7 was your interest, right? 10.7. So 10.7 will become semi-annual, right? Which will become 5.35, right? PMT is 5.3. FV so easy to find out. I told you it is always 100, right? Because it is given 97.50 and this is minus 97.5. Right, so just you can input this in your calculator, you will get I by y. But here there is again a small twist which a lot of students miss out, right? A lot of students miss out a small twist that and which can be confusing in exam, right? Because when you will solve this question, right, you will get answer as, even though here the options are easy, right? Right, here the options are little easy, but the point why I'm telling you is sometimes uh, what happens is that sometimes people get very close options, right? So when you will solve this, you will get I by y equal to 5.64. See, again, the logic is very simple. I told you that day also. See, apple to apple comparison. Always remember discounting, interest rate, right? Things have been, if you are solving everything, if your PMT is semi annual, PMT is payment is semi annual, N is semi annual, SA. Your I by Y, which will come out by calculator, will also be semi annual, right? And generally, what I'm trying to say, generally, please remember my words, guys. I'm telling you, I'm trying to remove your confusion, which you will think later on. I'm trying to resolve everything right now itself. Generally, this creates a lot of confusion among students. So remember very clearly that it is apple to apple comparison. If PMT is semi annual, if N is semi annual, right, then I by Y will also be semi annual, right? It cannot be different, right? Because ultimately it's a financial calculator which is working, it's a machine which is working. Machine, you like think of your calculator as a computer, right? If computer you are doing everything in Word, the answer will not be in PDF, right? So the output will be in Word only, right? So I'm just giving a very crude example, but I'm trying to say machines, whatever input they take, that same output comes out, right? So it's a machine which is working. So you should be clear of the limitations of the machine, right? Machine, you have to put negative sign. If you don't put negative sign, because that is the setting of the machine. If let's say you don't say, I sir, I'll not put negative sign, you will get the wrong answer, right? So you have to remember this in settings of the machine, that this is how the calculator works. So what I'm trying to say is that remember this thing. So the YTM, generally, I was telling, generally YTM, whether you are giving CFA, FRM, any exam, YTM is quoted in per annum basis, PA basis, per annum, right? So even though it is not written here, nowhere it is written here, YTM of the bond is closest to 11.2, 11.5, 11.71, right? But it is the convention, right? YTM is quoted per annum. This is a convention. That convention means this is the rule which the finance people follow. This is like same thing in India. You drive left hand side. In US you drive right hand side. So nobody can say na that why are Indians driving at left hand side? India should drive at right hand side. If you try to drive on the right hand side, what will happen? Police will catch you and you will be fine, right? And if you try to drive on the left hand side in US, police will catch you and you are fine. So will not say there stupid things that no sir, I was driving left hand in India, so I will try to drive left hand in US also. Will not say that, because this is the rule of the land, right? So similarly, this is the convention of the land. This is the convention of the financial people, that they put YTM, even though nothing has been written here. What I'm trying to say is they will not tell you whether YTM is per annum or semi-annual. Convention is per annum. So, as a financial student, you should remember the convention. Convention is per annum. They will not tell you. They will not, write in the question that YTM is per annum. They will not write it. You should remember it. That YTM convention is per annum. So I need to convert. Right? I need to convert 5.64 into 2, which comes out to your 11.28. So that is the answer, right? So remember, these are all small things trouble, especially new students like you guys are coming in financial world. So this is what it is, right? So remember the convention. My point here is, and remember this also, that it's a apple to apple kind of thing, and you are putting things in the machine. Machine will give out. If you are putting in machine, you are putting apple. Don't expect a orange juice to come out. Only apple. If you put apple in a mixer, only apple juice will come out. Now, orange juice will not come out, right? So it's that kind of mixer at your home, right? So it's very simple in that way, right? So remember these small things. It troubles students, right? So otherwise, not difficult. Okay. So remember this part. So this is also done, right? Next question again. Okay. Another one. Now, in this question, what is happening is that we are trying to look at the dividend and everything, and we are trying to figure out a few things. Okay. So let's try to look at the answer, right? Myland, Mylandia Corporation stock trades at $60, right? Fine. Fine. Stock is trading at $60. The company pays an annual dividend to its shareholders, and its most recent, again it's confusing. Most recent means past only, is 2.40. D not 2.40 occurred yesterday. Perfect. Analyst following Myland expect the company's dividend to grow at a constant rate of so and so. Myland's required return. Okay, required return. Required return, you should know required return is KE. So very easy. Remember V naught is equal to D1 KE minus GC. So they have told you to find KE minus GC is equal to D1 by V naught. KE will be D1 by V naught plus GC. Right, so it is so easy. So KE is equal to, what is D1? D1 is 2.40. What is so D naught is D1 will be 2.40 into your 1.03 into 1.03 D1. V naught is what? V naught. V naught is stock is trading at 60, right? That is why V naught is given, and GC is your 0.03, right? So this is what you have to do, guys. 2.40 into 1.03, right? And you multiply that with your divide by 60 and 0.03, right? Very simple, very straightforward question. Just have clarity, right? Just have clarity how to go about it. If you have clarity, this will not take much time. Okay. You should know what is the required return, right? What is question asking? Question is asking you required return, right? Which you can solve, right? This is what they have done. Very simple. Answer is 0.03. These are easy questions. Only requirement is that you should have conceptual clarity. Next question. So let's do next question. So if you look at next question, right? Next question again. Now we are here looking at forward price to earnings, right? Forward price to earnings, little tricky, but again you will be able to solve it. I'm pretty sure. Let's try to do it. Okay. So in this question, what is happening is that an analyst observes the benchmark Indian Nifty 50, right? Stock index trading at a forward price to earnings ratio of 15, right? So you say forward price to earnings. So you are saying that, okay, fine, it is VT ET plus 1, right? Forward price to earnings now at 15. Okay. The index expected means next one. Expected dividend payout ratio in the next year is 50%. Index required return is 7.50%. Okay. So basically your KE is equal to 7.50%. Your GC, right, is very high, right? Next year. Your dividend again, and it is not actually, this is also tricky. This is dividend payout. This is not GC, to be fair. It is dividend payout ratio. Now, this kind of things, since you are studying this topic for the first time, so you will be confused because suddenly a new term has come, right? They have given you your dividend payout ratio, right? Now the question comes is that uh, what exactly is a dividend payout ratio, right? What exactly dividend? So what you need to understand here is dividend payout ratio is a fancy name of a very simple thing. So in finance, as we go ahead, you will realize anything which is a payout ratio, etc. It's a ratio, so it's a dividend. So you are paying dividend, and then you are dividing by something. Dividing by your basically what is saying dividend payout ratio in the next year. So you're dividing by generally dividend payout ratio is in simple term dividend by earnings. But the question is telling you dividend payout ratio in next year. Dividend payout ratio generally is this, but in this question, please understand this is the beauty of CFA exam that CFA exam each word is very critical. In this question, the question says dividend payout ratio in the next year. So it means it is dividend divided by your earnings of the next year, which is if dividend is T, earnings is T plus 1. So this is given as 50%, means 0.5. Now, once you have seen this, then it should suddenly strike you that, oh, the question is trying to trick me. Question is very easy, but question is trying to trick me. So if you remember the formula was Vt divided by Et plus 1, right? And I told you it is dt divided Et plus 1 Ke minus Gc. This was the formula, right? So this part is given as 0.5. So question is just trying to make the question look it very difficult, but it is very easy to be fair, right? Look, okay, if the analyst believes, right, if the analyst believes that the Nifty 50 index dividends will grow at a constant rate of 4.50%. So this is given to me now, right? The answer this is given to me 4.50%, right? So I was searching for it, but now I found it, right? 4.50%. Which of the following statement is correct? Okay, let's see. So if I solve this now, so now it is saying Nifty analysts should view the Nifty as overpriced, underpriced, or fairly priced. Okay, I'll answer that question also. Again, VT by ET plus 1 is equal to zero point 0.5. And what is KE? KE is 7.5%. GC is 4.5%. Right? So 4.50%. Right? Then if you solve it, right, you try to solve this part zero point 0.5 your divided by 4.5 uh, okay 7.5 minus 4.5, so the answer which is coming as 16.67, right? Now, so answer you got as 16.67. Okay, then analyst observed analyst has observed that the forward price to earnings, right? Analyst observation was this was analyst observation. Analyst observation was 15. By your mathematical calculations, right, you got 16.67, right? So the idea here is, right, that if you think, right, now the question comes, how do I answer it, right? Because you are getting 16.67 mathematically, right? Your, you know, analyst is saying 15%, right? So it is underpriced or you're overpriced, right? How do you figure out that? Anybody can, conceptually understand, like, how do we answer this? It is underpriced or overpriced, right? Basically, your analyst is saying, so okay, so analyst should view the Nifty as overpriced. Analyst should you view the Nifty as underpriced or fairly priced, right? So, in simple word, like this is very confusing. A lot of students get confused. I'll try to give you a sense here, which will help you later also, right? See, one is analyst belief. He believe his belief is 15, right? One is calculation. Calculation is 16.67, right? So there are two things here now. Analyst is believing that the benchmark Indian Nifty 50 stock index trading at a forward ratio of 15%. But when he calculated, right, when mathematics worked, right, the forward price to earnings, right, forward price,
What do they mean by forward price to earning?
right,
What
so
they are expecting?
no, so okay, so it is basically it's similar like your forward P, right? Forward P by calculation is coming out 16.67%. Analyst might have calculated by his own ways. Maybe he has used some other ways, right? We don't know what he has used. By his own ways, he might have seen some charts, he might have used some other data, right? I have no clue, right? My calculation says 16.67%. And right now, see, the basic idea which you should always remember that whenever you calculate something by calculation, that is maths. And I always say to students wherever I teach that in finance world, we consider whatever comes by math as, at least for exams. I told you, right? In real world, things work very differently. But for exams, whatever comes out of maths, that is God. Right? That is God means that is truth. So this is the truth. This is analyst belief. He has done his by his own ways. How he has done this calculation, I have no clue. Neither I am interested also to know what he has done. For me, this is the truth. For me, the calculation, the maths is the truth. Again, real worlds will work very differently. But what I'm trying to say that in these kind of exams, CFA, FRM, CQA, whatever, that this is the truth. So truth is that forward price to earnings, right, is 16.67. Right. Analyst belief is your 15, right? Now the question comes is whether it is your overvalued or undervalued. How do I decide, right? Now the question comes is that the fundamental input into the equation, right, imply a forward price to earning of 16.67 rather than 15, right? You can answer this question by other way also, right? You can answer this question for other way also, that if you like, if you are getting, I will come to both points, right? You can now do one more thing. What you can do is that you say that okay, let's, if analyst has taken 15%, let me put 15% as your forward price to earnings, which is VTET plus 1. Then I should put same thing, right? Basically my formula was what, VT ET plus 1. This is very confusing, guys. So that's why I'm trying to. Uh, once you will understand, you will figure out. But first time, whenever somebody do it, they always get confused. So what I'm doing is that I'll say that okay, let's see what analyst is saying. Analyst is saying that okay, this is zero point 0.5. I'm putting the same value. Let's calculate. Let's calculate GC, the growth part, right? Let's calculate the GC, right, using your analyst forward price to earnings. So KE is same 7.5%. GC I try to calculate. So GC if I calculate from here, it will come out 4.166, right? something like that. If I calculate GC by your analyst way, right? So since the analyst, uh, what you say, if I put it 15, right? Since the if you solve for G, that yields us a result of your 4.661667. Since the analyst is saying that there is higher nifty dividend growth, right? If you see, if you do the calculation part, right? Now GC, which came out from 15, right? So this was analyst observation. Okay, this is analyst. Okay, which I should not write belief. I should write observation. I think that will be better word. Observation. So analyst observation was 15, right? In 15, the growth rate of dividend is 4.1667. When he did maths, right? When he did maths, the GC came out, in the market was 4.50. So basically, if dividend are growing at higher rate, you tell me, if companies or if any index dividend are growing at higher rate, right? Right. So what is the what you say? What is the expectation of future? The expected, if somebody tells you that the dividends are growing at higher rate, right? uh, if you observe your data, you are observing it, your observation says this much, your calculation says this much, right? So your math says this much, so you obviously believe the calculation. So you say that, okay, right now when i see market prices, when I see market prices, I see GC is equal to 4.167. When I calculate by maths, right? When I calculate by maths, right? Maths tell me that GC is equal to 4.50. So since math says, I tell you God, we believe in maths. We see no, whatever we are seeing in market prices, that is not true. Maths tells us the right picture. We will believe in maths, right? Now, simple point is, you tell me, if current market prices is showing you less growth, but your calculation is showing you higher growth, you'll definitely say na that, oh, this is so nice. Current market prices are not showing the true growth. Current market price is showing less growth. Current market prices is showing less growth, means people are not realizing the true potential of Nifty 50. True potential is 4.50. So it means it is underpriced. I know it's very confusing, but get a hang of it. The whole logic, right? Whole logic in both of, let me summarize in two ways. One way is, again, try to understand, this kind of question will come a lot ahead in future chapters, right? And this will keep on confusing. One is, see, why are you learning CFA? Like, let me put it that way. Why are you learning CFA? You all are learning CFA to become good analyst. Right? Maybe you want to work in banks, that is one choice. Maybe you want to become portfolio manager, that is one choice. Maybe you want to run your own, investing firm, etc. That is one choice. What is the key skill of an analyst? Key skill of an analyst is to identify undervalued security, right? That is what Warren Buffett says. Na yesterday he wrote his last shareholder letter, right? So so ultimately, what is Warren Buffett's philosophy, right? I told you CFA is mostly Warren Buffett's philosophy, right? That you are identifying the undervalued securities. So the whole point of learning CFA is to become a good analyst, right? Identify undervalued securities. So to do that, we have two thought process. One is we observe market. One is we do the calculation by maths. Our reference point is always math. We believe in math because we say maths is God, right? So we believe in math. Now, when we observe the market, we are seeing the GC is equal to 4.1667. Our math says GC is equal to 4.50. So we will say that okay, market is not showing the true picture. Maths is showing the true picture, and maths is showing the higher growth rate. It means it is underpriced, right? If you look at your forward price to earning, market was showing 15. Your maths was showing you 16.6 something, right? 16.67, right? So market was showing you 15. Market was saying that your next period growth forward price to earning will be 15, right? This was market was showing you, but the real thing, right, which is maths, which is God, is showing you 16.67. So you will believe here. You will say, oh, it means market will rise more. You will say, no, oh, forward price to earning is higher. Means there is, India will see more growth. India will see more, the stock price will rise more. So let me buy this. It is underpriced. Let me buy it. Right. So underpriced, let me buy it. Right. And just to simplify again, because you're doing it for the first time, guys, this kind of question always come in exam. They want to test your understanding. The whole logic, please understand, which I tell to wherever I teach these kind of subject. I always tell people that see, the whole world operates on one principle. If somebody tells you now that uh, define finance, if somebody tells you, can you define what is finance, or what is portfolio management, or what is your whole, why do you study CFA, FRM, CQF, anything you study, why do you study everything? Though, if somebody tells you that, can you define whole everything in finance in one line? So that one line which I have created is that the whole finance can be defined in one line, that is buy low, sell high. Right? This is the crux of learning everything. Right? You are learning CFA to do this. You are learning CFA or everything in finance to do this only, that how do I identify undervalued security and I buy it, then the price goes up, then I sell it and make a profit. Or you can reverse it, right? Sell high, buy low, right? This is your basically short selling. This is called short selling, or this is normally not allowed. This is generally in derivatives, right? You can do short selling also in stocks, also in intraday and derivative also, right? So this is little complicated version of the same thing. This is the easy version. This is the difficult version, right? But the one line answer to studying everything in finance, why are you studying CFA, is this, that you have to identify underpriced security, you have to buy it. When the stock price rises, then sell it. This is what Warren Buffett said now, when he said that, be greedy when other are fearful, and be fearful when other are greedy, right? So that this is the same logic, right? You buy when market crashes, you buy when people are worried, you buy when you get a security at a very cheap price, and kind of thing, right? So this is what we are doing, right? This is the whole point, and you will see again and again in CFA that, please keep in mind, people get very confused. So that's why I give this God and all that I write. The logic is this only, that always remember that this side is always right. Don't try to follow what market is saying. Market is emotional, right? Please understand why. You can, somebody ask, somebody can ask me that, sir, why market is showing different? Because market runs on emotions. Market, there are every kind of investor. Market has retail investor also, market has professional investor also, market has hedge fund also, right? Market has all kind of people, pension funds also. So every person when participate in markets, so everybody is doing a different thing, right? So this is where you know, market is moving as per suddenly, if you know, let's say something happens in US, market crashes, right? So because emotions overpower. Why something foreign in US should affect India, right? But it affects, right? It affects because emotions, right? Today, suddenly in evening the this thing came out, right? Exit poll result came out right now. Gift Nifty, right? Gift Nifty is our index, right? Gift Nifty is up, right? Gift Nifty is up because it is showing that BJP government will win, right? So why it is up, right? Emotions, right? So this side is emotional, market is emotional. The whole idea of CFA studying is that you have to not be emotional, you have to follow the maths, right? So this is, I'm just putting it in too many words today, but the whole idea is this, that don't follow emotions, follow the math. The maths is god, right? And whole, in real world things work a little differently, but at least in the theoretical world, in the what do you say, CFA FRM world, you need to do like this. In real world, you have to take care of emotions also, to be fair, because there is a breakout trading, there is, momentum trading. Momentum trading works on emotions, right? So you have to be very clear, right? So there are different kind of trading, right? Don't think that this is bad. Emotions are not bad, right? There is a way to trade emotions also, right? Euphoria in the market is traded through momentum trading, breakout trading. That's a different level of study, which is part of CFA also, but that will come in CFA level 3, right? CFA level 1 2, there is no discussion about momentum trading and all that, right? So again, I've told you a lot of things, but the whole idea, because these kind of question you will see a lot. Again, we will do such an analysis. One is market price analysis, very emotional analysis. One is mathematical analysis. Every time we will consider mathematical analysis supreme, and we will consider that as better, and then we will say that, oh, mathematics is saying that your forward price to earning is better, it means today it is lower, it means buy it under price, right? So that's the whole logic. Okay, try to go and learn about it. Not very difficult, but yes, earlier you learn it, it will help you, because every chapter you will see such kind of question, right? And such kind of analysis they want from you. Okay, because I told you logic, right? Ultimately you are learning CFA for this one line. This is the crux, right? Like, whole CFA FRM CQF is this line: buy low, sell high, right? This is the only one line in finance. This is the one line in business also, right? To be fair, this is what business is, right? Whole world is working on this one line, right? If you see Apple products, right? Apple manufacture its phones in China and India, right? And sell it at, manufacturing cost is only 400 or $450, I think. It sells for $1,000, right? So the whole world works on this only: manufacture cheaper, sell higher, manufacture cheaper, sell higher. Okay. All right, we deviated a little bit, but that was necessary because uh, you need to have this in mind very, very clearly. Okay. All right, this is done. And next one we do now. Where is the next question? Okay, so this is done. And okay, now we have to go back. So just a second. So next one is your cash flow additivity principle, right? When you talk about cash flow additive principle, basically it states that the present value of any sequence of cash flows is simply the sum of the present values of individual cash flow, right? So again, this is pretty straightforward, that you just add the cash flow, right? Any sequence, right? It doesn't matter, right? Which sequence you are adding, right? But then ultimately you have to bother about the uh, total value, right? Cash flow additive principle is the basis, and the law of one price no arbitrage principle, right? The law of one price no arbitrage is, it says, uh, if two assets or portfolio produces identical future cash flow, they must trade at the same price today, right? So same logic, cash flows are same, the price should be same, right? So you can replicate it also. A complex asset such as a coupon bond, which has a different stream of cash flows, can be viewed as a portfolio. Simpler asset, a series of zero coupon bonds. I'll tell you how it works. If it is given ahead, I'll explain you. The price of the coupon bond must, I'll tell you what it is, to be fair. If the price are unequal, investor must profit risk free by buying the cheaper asset, which I told you. Buy the cheaper one under price and selling the expensive one. Buy low, sell high. Is known as your arbitrage, right? And what it says is, it if you do it longer time, slowly a lot of people will also do it, and so, the arbitrage will go away, right? So you always have to find new ways to make profit. Okay, so okay, they have not explained, so I'll copy paste the question also, and I explain you the whole thing
No,
also.
quick question. Can we go to the previous screen for one second?
Just a second. Okay,
So
so
again, over here, it's assuming that two assets will produce identical future cash flows, they must trade at the same price. So
yes,
again, that, as you told me in Gordon Growth, that's a simplistic assumption you said, right? Because the equity has its own value beyond the future dividend.
yeah,
So
yeah,
if in this case also that is true, that it doesn't have to be that two assets that produce identical future cash flows will be the same price, then that means that arbitrage will be possible.
yeah,
Like
yeah. So,
it won't
let me
really
let
get erased.
Yeah, yeah. So let's go back to one note. I'll explain you there. See, the idea is uh, very right, right? What you are telling. So let me go back there. Fine. So coming back to your question, see, when you talk about law of one price, right? Law of one price again is a theoretical concept. Like Gordon growth model, this is also a theoretical concept, right? So this is also logically only exist in theory. In practical world, it doesn't exist because I told you, right? In practical world, your emotions exist, right? Like I'll tell you simple. Tesla. Tesla stock is has such a high price by earnings ratio, right? Why? Because people have a lot of faith on Elon Musk, right? There are companies which are, if you compare Tesla with BMW, right? If you compare Tesla with Ford, right? If you compare Tesla with Mercedes, right? So Tesla's market value, right, or your market cap is like the combination of these all these companies. Why? And even though sales of Tesla are less than these companies, individual companies. Why? Because emotions is that people believe that Elon Musk is a Wonder Man kind of person who can do anything, and people believe in that, right? So again, you will say that cash flows produced by BMW, Mercedes, and Ford are similar to your, or even higher than your, you know, Tesla, but still they trade lower than this, right? So that is the whole logic that in real world emotions overpower. And that will true in like India Adani Group, right? India Adani Group, generally trades higher, right? Because people believe that maybe there is something between incumbent government and Adani Group, right? So similarly, Palantir, right? Palantir is another company in US which is basically backed by your this guy Peter Thiel, right? That also trades at 650 times of PE, right? 650 times, right? So 50. So again, what I'm trying to say, in market anything can happen, right? Because emotions run high, right? But in theoretical world, we are this law of one price and what we discuss, Gordon growth model, etc. Those are theoretical concepts. They say that in theoretical world, yes, this should happen. They should trade at same price, but in reality, it does not happen. Make sense?
Yes, it makes sense.
Yeah. So okay, let's do another thing which your book mentions, which I kind of skipped and did not cover, is that they mentioned a simple point there, which uh, is that uh, A coupon paying bond can be represented as a combination of zero coupon bond, right? So this is also important to understand. Why it is important to understand is that, please note specifically here that, see, let's say there is a coupon paying bond, right? There is a coupon, it is a bond, 5-year bond, which is paying cash flow. Let's, okay, let me write down the bond configuration also. Let's say there is a 5-year bond. The face value of the bond is $1,000. It is paying you 8%. I by Y is 8%, right? Semi-annual coupon. Okay, let's make it easy. Put an annual coupon only. Annual coupon, right? Kind of stuff, right? So we are, if I make the timeline, so 1, 2, 3, 4, 5, right? So the coupon which is coming here is 80 because 1,000 into 8% makes it 80. Coupon which is coming here is also 80. Coupon which is coming here is also 80, 80, and your 80 plus your full value which is coming, right? So the idea here is that this bond has 6 cash flows, right? 5 coupons and 1 face value, right? So I can write this like cash flow 1 is equal to 80, which will be discounted at 1 plus, or you say discount rate is, right, your, okay, this was not I by Y, this was coupon, right, annual coupon 8%, and your YTM discount rate, let's put it as your, what you say, 6%, right? So discount rate is 6%, which is given. So you'll say that, okay, cash flow 1 will be discounted at this thing, cash flow 2 will be discounted at this one, cash flow 3 will be discounted at this one, cash flow 4 will be discounted at this one, cash flow 5 will be discounted at your this thing, cash flow 6 will be discounted at your, right, again 5. So what your book states, or it is generally said in your all these financial books, is that you can consider, because this is one cash flow, right, and discounted by one rate, you can consider that ZCB1. You can consider that zero coupon bond 2. You can, so basically what they are saying is that these all 6 cash flows, right, if you see this, this thing is discounted like this, so consider it as ZCB1. Next, your second, if you put second cash flow, it discounted like this, put this as ZCB2, right? Third cash flow, right, it discounted like this, count this as ZCB3. So what they are saying is that basically you have to add all these now. So count this as ZCB1, zero coupon bond 3, zero coupon bond 4, zero coupon bond 5, and zero coupon bond 6, right? So difference is that this 1 to 5 zero coupon bond has 80 as the final value FV. ZCP6 has 1000 as the final value, right? So what they're trying to tell you is that a coupon paying bond can be represented as a combination of ZCB as well, right? So it's just a different way to write the same thing, nothing else. Okay, so that's the whole idea. All right, let's come here and discuss now. If you require an 8% growth, if you require, right, your requirement is 8% return, and you must invest USD 500,000. Okay, that's given. Which of the investment opportunity given below table you prefer, right? Opportunity 1 or 2, right? And why, right? So the logic here is we have to kind of calculate, right, which opportunity gives us more value, right? And the best way to do it, we have to follow the that cash flow additivity principle. You have to compare the two opportunities, uh, you know, and then see, right, which one has your better cash flow, right? So if you, there are different ways to do it, to be fair, right? There are different ways to do it. There is not a single way to do it, but the whole idea is that if you kind of, one way to do, I'll say, is that you subtract, right? Basically you have to compare 1 and 2 now. If you have to compare 1 and 2, you do what? You check how their cash flow differ. Same cash flow, no difference, zero, right? So no difference, so there is no difference here. Here you are saying the cash flow opportunity 1 is lesser, this is your more, right? If I subtract 195 minus 225, it is minus 30, right? Cash flow second period, again this is zero, right? So this is zero. Now last one, if I subtract 195 minus 160, right, it is coming as 35.008. Now I'm just telling you a hack, right? I'm just telling you a hack, very easy, because we learned the principle, right? Cash flow additivity principle was that if you have same cash flow, you should uh, trade at the same price, right? Both are equally good. But now I'm saying, okay, let me compare the cash flows, right? So it's similarly, right? The two friends who are discussing that I am making this much money. Then you say, now, okay, let's see who made more money in first year, who made more money in second year. Then you said, and then you realize that, okay, fine. When we compare it, right, simply by your subtracting each other cash flow, right, for 4 years, right, which we realize that, okay, if you find the present value of the this difference, right, uh, okay, then you realize that, okay, let's try to kind of, right, calculate that what is the present value of both things, right? So these are the cash flows I'm getting. Now I have got this cash flow. This is, I think this calculation is little off because this is 34.992, right? So if I now, the these two cash flow are kind of, there is no difference. So basically this cash, if you see, first opportunity has 35 more, right? Second opportunity, if you kind of consider, has 34.992 more, right? So but time period are different. It is t is equal to 3, this is t is equal to 1, right? Now if you try to take the present value, right, in the first case you try to go back, you know it's t is equal to 1, not even. So if you try to go back here, right, only, or if you don't want to make it so complicated, just you can do it full thing also, right? 195, 195, 195, right? Just calculate the present value of these three things, right? If you try to calculate the present value of these three things, what will happen? You will have 195, 1 plus your 08 raised to power 1, 195, 1.08 square, and 195 your 1.08 cube, but you have the present value of this minus 500 also. So how do you do it? The way to do it, the PV is equal to minus 500, your PMT, the cash flow which is coming is 195, right? N is equal to 3, right? And I by y is equal to 8. Then you compute your FV. If you compute your FV, you will get the answer. Similarly, if you go here, right, you can do for this one also, right? You do same logic. I'm just telling you both things, right? Minus 500 to 225, 195, and your 160 point. This is the easier version. This is, you don't have to apply any logic, right? You can do easier version by this, right? Then we'll come to the hack, right? So if I put it PV is equal to minus 500, your cash flows are different now. Here, CF naught, CF1, and you CF, here we cannot do like this also, right? So in fact, you you don't do like this, right? Okay, I think that will again create. You do what CF not CF1. I think that will be much better because both are similar, right? You do CF naught minus 500, CF1 is equal to 195, CF2 cash flow 2 is equal to 195. Both way you can do it, guys. I'm just trying to put it because here also I'm writing the same formula now. CF naught is equal to minus 500, CF1 is equal to 225, CF2 is equal to 195, CF3 is equal to 160.008. Right, so you can do like this. Just take it as a homework, like do it, practice if you can solve it. But when you will solve both of these in your calculator, you will realize that both ways the value is coming same, right? Both ways the value will come same, so it will be indifferent between the two opportunity, right? So try it out anyway, right? Whatever you want to feel. Hack here was that I was trying to put across was the differences. I was saying that okay, 30 is coming here. If I take 30 discounted by 1, 30 point your 108. That was one. And another one was difference what 34.992, right? Divided by 1.08. This was 34.998, right? 34.998 divided by 1.08 cube, right? If I do it 34.998, right? Or let's say 1.08 raised to power 3 is this one. I take 1 by x of that and multiplied by 34.998. So I get this value is 27.78, right? And if I do the previous one, right, your 1.08 and then 1 by x, and I multiplied by 30, sorry, 3, and into 10, right? This value also comes out 27.777, right, which is 27.78. I hope you got, like, there are two, three ways you can do the question, right? One is this is a lengthy method. One way is the lengthy method, which is this. You find the cash flows of all, you find the cash flows of all, right? This is your lengthy method. One is the hack, which I told you, right? One is the hack I told you that if I subtract the cash flows, here the cash flow, here, if I put it, here this guy was higher, T1 was higher, here T2 was higher, right? The opportunity 2 was higher. So what I have done is I am saying in a simple word is that okay, so it all boils down to this logic that opportunity 1, you have 0 here and 30 here, 30 dollars or rupees advantage. Opportunity 1. Opportunity 2 is 0 and your 34.998, right? 34.992, 998 or 992, 992, right? 992, right? That's why some difference was coming, right? 992. If I take 34.992, so here I have to discount one period. So my value is 30.108. Here I have three periods. This is third period. 34.992 divided by 1.08 cube. So this is the difference between two, right? So both I solved, I get 27.77 and 27.77, right? So that shows me both are same. So I have given you this hack also. This is the easier way to calculate, guys. But again, you have
That's
to understand that thing, then only you can reach here. Longer way I also give you, right? Whatever you want to write, shortcut hack you want to follow, that you can do. Longer way you want to follow, that you can do. Right? Not a difficult question. It's just a tricky question.
Does it not matter that one is positive and one is negative? Would it
No,
not cancel out?
no, not. See, this is here 1 9. See here, if you see, it is. What are we discussing here, right? If you see, here this guy is less, right? 1 minus 30, right? Here this guy is whatever, like symbol doesn't matter, right? To be fair, basically here this guy is 34.92 stronger, right? So the idea is they here 34.992 is better than opportunity 2. Here your opportunity 2 is better, right? If you see here, it is 225 now, it is bigger. So here opportunity 2 is better. So actually opportunity 2 is that 30 wala, right? This is opportunity 2. This is opportunity 2. This is opportunity 1. See, it will not be cancelled out because timings are different na. See, whole idea of studying the time value of money or the calculation is to show you that different time periods cannot cancel out. Only same 500 were cancelled out because they were same period, right? 500 cancels T0, 195 cancel T2, but T1 is equal to here opportunity 2 is better, T3 opportunity 1 is better, right? So they cannot cancel out, right? They cannot cancel out. You have to find out the time value of money of these, and that is what I am doing, right? I'm saying that okay, rest all is equal. If I have to do a comparative analysis, here $30 is higher in opportunity 2, right? So the value comes out at 27.7. Opportunity 1, the last one is better, 34 point your 992, right? That is better. So that is the advantage, and that's why I get it, right? So it will not be cancelled because time periods are different. One is T1, one is T3, right? When time period are not same, it will never be cancelled. Okay, that's the whole idea of time value of money study. But again, there are two hacks here, both ways. This longer way you can also do it, I'm not denying it. This is generally people do like this because hacks people don't remember, right? Generally people follow this method. That is also totally fine, but it's just a time consuming way, right? It's just a time consuming way. Otherwise, you know no, if you can't remember hack, just follow this normal calculation, input in calculator very fast, cf naught, cf1, cf2, cf3, calculate the present value. Here also calculate the present value, both will come out same. That also you can do, right? There is no problem in that. I have given you a hack also because in your book, right, they have given a hack, so I just wanted to cover that. Okay, so very interesting question again. Concept is easy, but the questions are quite tricky. Okay, so next one is your forward interest rate. I think, uh, okay, forward interest rate will be able to do forward currency rate. Okay, let's not do this. The reason is that forward interest rate and currency are kind of related. Because if I touch interest rate, I touch currencies also. Okay, so let's not do it. Okay, we have not covered the full chapter. We have left with forward interest rate. We are left with the forward currency exchange rates, right? An option pricing model and option pricing model example. Some questions, right? So tomorrow 1 hour at least will go in this. It's okay, right? We don't mind doing it, but we'll not continue ahead because we'll not be able to complete in next 7 minutes. Okay, so that's the part. So let's stop here. Quite tricky questions. Go back, try to solve it, and tomorrow we'll continue from here. All right.
Okay,
Okay.
thank you so much.
So thank you, thanks a lot.